Okay, today I'm going to give you an introduction to give you an overview of the financial markets and the financial instruments that are exchanged in those markets. Um, and this is important because what you're being asked to do as part of your trading assignment and as part of the other assignment that you will be facing is to partake in the financial market. You'll actually be participants in the financial markets, and you'll actually be trading financial instruments. So you need to understand the overview of the financial market and what kind of instruments we trade when we are asked to trade these instruments. I think my pen is working now. Yeah, that's it. Okay. Now, many students, I mean, I've been teaching since 2007, and many students have asked me, what do you mean by the financial system? What is a financial system? It's quite difficult to explain what the financial system is because it's such a complex thing. And if there is a simple enough explanation for it, that's what you got on the board right there. I mean, that is a map of the financial system. The two key parts of the financial system are the lenders, the people who lend money, and the borrowers, people who borrow money. Now let's just take a step back and understand who is a lender and who is a borrower. Let's say this half of the class are lenders and this half of the class are borrowers. So think about it. If you're a lender, what does that mean? And if you're a borrower, what does that mean? If you're a lender, what that means is you have more funds, what we loosely call money, but from now on we'll call funds or capital, than you want. So in order for you to be a lender, you have to be a net saver, meaning that the money you have is as a result of you not spending everything that you earn by way of a salary, by way of profits, and therefore you have surplus funds. Okay? So lenders are people who have surplus funds or surplus capital. Okay? And lenders can be households, they can be firms, they can be governments, they can be resident or non-resident. You can have foreign people who have surplus funds and who are looking for ways to invest these surplus funds. Borrowers, on the other hand, I know a lot of what you see on TV, they say borrowing is bad and over borrowing is a disease. But in our system, objectively speaking, borrowing, you borrow because you have a purpose, you have a use for funds, but you don't have sufficient funds. So this half of the class, you're borrowing. What are you borrowing for? Let's say you have this brilliant business idea. You've identified a trend in the market, and you want money to set up a company or a business or a production unit. You understand? Yeah? Nod your head if you understand. So I know you understand. Okay. And let's say it costs you say £1 million to set it up. And in the future, you expect the profits to be over 10 million. So do you think it's worth it, you investing that 1 million today so that you can generate that 10 million in the future? It's absolutely worth it. But what's the problem? The problem is you look at your bank account and you only have 100K. That's it. You only have 100K to play around with. So you need £900,000 more. Where are you going to get it from? You're going to get it from these people. These people who have surplus funds, and you're going to ask them for money because you don't have it. And that's why you're borrowing. Right? You'll have to, at some point, in some shape, form, or the other, to pay them back. Right? Whether it be if you're taking a loan, you have to pay back the principal and the interest, or if you're asking them to invest as shareholders, you got to pay back the dividends. Right? Whatever form, shape, or form, you're paying it back. But it is worth it for you to do so because with that investment, you generate a more than sizable return. Okay. Now the problem is that you guys are all in one room, and you guys know each other. But in the real world, we don't know who's got surplus funds and who's willing to invest. I mean, the people who are willing to invest in your idea may be millions of miles away and are perfect strangers. You don't know that. So if you are the borrowers and you have to rely on your own resources to raise the capital, all you can do is ask the people you know, your friends and family. And if they don't have the money, then you're stuck. Am I right? Yeah. Now, the other problem is that let's say these guys are not related to you, and they are not related to you, and they don't know you, and they're millions of miles away. Now, if somebody comes to you with an investment prospect saying, if you invest in this idea, I will, will generate about 40% returns annually. What's the problem as far as you're concerned? You have the extra funds to invest. You're looking for an opportunity to put your money to work so that it will be earning returns. Somebody somewhere comes to you with an idea that will generate the returns, but you still, as lenders, you're still reluctant. Why is that? You don't have trust. Yes. You don't know whether there's no guarantee. So what do we generally call that? Risk. Yeah. You are concerned about the level of risk that you'll be undertaking. So these people come to you and ask for investment. Sure, it sounds great. Sure, the returns are good, but there's a risk that when you invest in it, it'll go sour shape. It'll go sour, and you're not going to wind up with even a penny. Yeah. So the lenders, therefore, need to be assured that the risk that they take as a result of investing in this is as minimal as possible. And the other problem is, if you are an investor in a project and this project turns out to be a fraudulent project, and the people behind this project are prosecuted, you as an investor, you can also be prosecuted. You can face criminal charges for things that this company has done. If this firm has gone into liquidation, you as an investor, you can also face notification from the liquidator for reclaim of funds. So you as an investor, you take on a huge level of risk by doing so, right? Now, there are ways in which you mitigate it, but basically if you turn it into a private limited company, you actually mitigate the risk. I'm going to stop the record because I got a question there.
If anyone is
Yeah, go on.
Anyone is investing in a company which is
Now, so those are the issues, or those are the primary concerns that arise when you're trying to channel funds from people who have them to people who need them. And this is where the financial markets come into existence. This is the importance of the financial markets. The main objective of the financial markets is to channel funds from people who have them, have surplus, that's the lenders, to people who need them, and that is the borrowers. They act as a go-between to channel funds from the lenders to the borrowers. And that's what a financial market is. Now, when we say market, the basic definition of a market is a place where people meet to exchange something. So you have cattle market. What's a cattle market do? That's a place where people who want to buy livestock meet people who want to sell livestock, right? Let's say you have a fruit market or a Sunday market. Anybody been to a Sunday market lately? You go there, you see open stalls, you've got all these vendors, all these fruit producers, vegetables, fruits and all that. They come, they want to sell, and you're going there as the buyer. So it's a place where you meet to exchange whatever you're going to exchange. In the same way, the financial market is where you meet to exchange financial products. Now, the most basic financial product you can exchange is a loan contract. A loan contract basically says, if you give me such amount of money today, I will pay it back over this many years. So if you have a loan contract for £100,000, that means you give somebody £100,000 today. The contract says, over the course of the next 5 or 10 years, I will pay back this much of the £100,000 plus I will pay back interest. Yeah. So that's a very basic example. That's one example of what can be bought and sold in a financial market. And that is a very good example of a financial product, a loan contract. Another product that can be bought and sold over the financial market is a stock or a company share. You know what a company share is? Yeah? Let's say, who wants to start a company here? Let's say you want to start a company here. Give me the name of a company. Just put your first name and say PLC. Richka PLC. Okay? So we're going to start a company called Richka PLC. Now, the reason why Richka would want to start it as a company, there are two reasons. I may not be spelling your name correctly, but go with me on this, yeah? The reason is twofold. One, the advantage of starting a company is the moment you start a company, in the eyes of the law, the company becomes its own person. And if the company borrows money, and at some point in the future the company cannot pay back the money, the liquidator, that is the court-appointed person who comes to the company to sell off the assets, to liquidate the company's assets, and to reclaim the money owed to creditors, cannot touch the people behind the company. Can only seize the assets of the company. So Richka, who started the company, is safe. Whereas if she had not started this company and the same thing happened to her business, that the business goes bankrupt, then the liquidator can actually take hold of her house, her car, her clothes. You understand? Right? And that's what we call the corporate veil, that you have protection. There's separation between the people running the company, people owning the company, and the company itself. The other advantage, and this is where the financial advantage comes into existence, is where if Richka PLC were to, if Richka were to raise money for her company, for her business, she can only rely on the people who are close to her, people whom she knows, her friends, her colleagues, her family. Whereas if it's a company, this company can issue shares. So if you own a share of Richka's company, you're entitled to a certain percentage of the profits every year, and that's what we call dividends. So every year, the company will take the total profits it wants to allocate, and it will share out these profits according to the proportion of shares you own. So if you own 10% of the company, you're entitled to 10% of the declared profits, and so on and so forth. Now, shares are an effective way of raising capital, because if you buy shares in the company, you have to pay the value of the shares, but that's it. You know, your obligation to the company, your connection to the company is limited to the amount of shares you own. So if later on down the road, if there is any legal liability, you as a shareholder, you'll not be touched. You'll not be molested, right? It's limited to the company. So it is a safer way of owning a stock in a company, of being entitled to a share of the company's profits without taking on the risks. Okay? Because you're not somebody who's going to be involved in day-to-day running of the company. And as a result, if you are looking at buying shares in the company, you'll be willing to invest in the company shares. as long as the company is registered on a proper stock exchange. And this is what the stock exchange is about. If Rishka wants to turn her business into a PLC, she has to list it on the stock exchange. It's called getting a listing. So once it's listed on the stock exchange, she can now sell shares to virtually anybody. And you, as private individuals, you can buy shares in her company. That way, she accesses a wide range of investors. She's no longer limited to her close friends and family. She can actually sell shares to strangers. And every time she sells a share, she's getting money, because let's say each share has a £1 nominal value, has a £1 face value, which means in order to buy a share, Richka, you have to pay £1. So if she's issuing a million shares at £1 each, so she's raising a total of £1 million. So she's raised £1 million of capital from, say, 100,000 people, each investing roughly £10,000 in the company, without, and these people do not know who Richka is, do not have any personal connection with her. These are perfect strangers, but they're willing to invest. Okay, and that is the advantage of listing your company, because then that gives you a wide range of investors, and you can basically issue your shares to investors. And that all happens through the financial markets. And that's an example of how the financial markets actually bring people who have surplus funds looking to invest in touch with people who have good ideas and who need funds and are willing to pay an interest on it together. Okay? Is everyone clear about the importance of financial markets? Okay. Now, there are two kinds of financial markets. There are what we call the money markets and the capital markets, and I'm going to go into that in a bit more detail, and I'm going to go into capital markets in a bit more detail than money markets. Reason being that we are studying a module called capital markets and decisions under risk. But before I go on to that, you may be wondering what this is. What is this? What are these financial intermediaries? Well, the fact of the matter is, let's go back to Richka PLC. You want to buy shares in Richka PLC. All right? How do you do it?
Your broker.
Which broker?
And listed in the stock listing. Not listed. Any financial ratings in the broker are in.
Okay. And which one? Where do you find them? Yeah, but where do you find them? How would you find them? You go to your bank. You go to your bank and you say, I want to buy shares. Right? Your bank will say, okay, well, banks will take some of your details down, and they'll realize you are a private individual with this much income, and they will advise you most likely to open up what is called a self-select ISA. Right? A self-select ISA gives you the ability to buy shares in listed companies up to a maximum value of £7,000 or thereabouts, and any capital gains you make on that is free of tax. It's your tax bracket. And if you're a private individual with a certain limited income, let's say an income of less than 55,000, that's a good way to invest, right? You don't go directly into the London Stock Exchange, do you? No, you go to your bank. Now, where in this chart does your bank feature? Here, under financial intermediary. So you're dealing with the financial markets through a financial intermediary. Do you know who an intermediary is? Is the go-between. Yeah, yeah, yeah. So if you're a saver, and if you want to lend money to a borrower, you don't go to the financial market straight away. You don't walk into the London Stock Exchange and say, I got £100 I want to invest. They'll either arrest you or put you in the asylum. You go to your bank who is a financial intermediary, and I say, I want to invest. Now, you do that. You already do that, because how many of you here do not have a bank account? Okay. What do you think the bank does with your money? They don't just keep it under the pillow, does it?
They do business with it.
Yeah, they invest it. So you may, if you know, some of you may have a mortgage. How many of you here have a mortgage? Okay, so you are falling into that category, right? So you are borrowing money from people who are lending money through whom? Through your bank. Okay, and that's the importance of the financial intermediary. Individual savers and individual borrowers cannot interact with each other directly through the financial market. What they do is they go through an intermediary. They interact with the intermediary, and the intermediary deals with it through the markets. Okay? Now for this, I'm going to turn off the recorder because I'm about to say something controversial. You can further subcategorize, and keep in mind that these are theoretical subcategories. They're not actual subcategories. It just makes the task of learning financial markets easier. You can further subdivide the financial markets into what is called a money market and a capital market. Now, the distinction is very simple. It's money markets deals with financial instruments that are short-term. Remember I told you interbank loans, one bank borrowing from each other, from another bank, for 24 hours, 72 hours, short-term period. Now that is an example of a money market operation. That would fall within the money market category. Whereas if you are selling or trading instruments like shares or bonds, these are long-term. So if you sell shares in a company, if you take a company like British Airways, how long have their shares been in existence? At least several decades. If you take a company like Coca-Cola, how long have their shares been in existence? So these are very long-term market instruments, and that falls under the category of capital markets. So capital markets deal with long-term financial instruments, whereas money markets deal with short-term financial instruments. Now, money market instruments deal with things like discount markets, interbank market, and this is what we just touched on very recently. CD markets, gilt, repo, all that. Now, if you want to know more about money markets, I'm not going to go deeply into money markets today. The reading is Howes and Baines, 2007, chapter 5, which I'll be telling you how to get hold of towards the end of the lesson. Okay, you will find the link on that on this week's Blackboard folder. Okay. What we are interested in is the capital market. There are two subdivisions of the capital market. One is the bond market. The other is what we call the equity market. The bond market is you're looking at long-term financial instruments that are to do with borrowing. These are debt instruments. So, for example, if you're a corporation, if you're a big company, and you want to borrow money, one option you have is you go to your bank and borrow that money. But you may feel that it's better borrowing it from the general public, borrowing it from the open market. And the reason could be that the terms and the interest rates might actually be cheaper in the open market. The bank may actually be charging you a higher level of interest than you can get in the open market. Now, we know about shares. We know about how to issue shares in the open market. In the same way, a company can choose to borrow from the open market. Now, if you're issuing shares to raise capital in the open market, to borrow from the open market, you issue bonds. So, in particular, you issue something called a corporate bond. Now, you issue a corporate bond. Now, what exactly does a corporate bond do? If I'm the company and I issue corporate bonds, let's say I denominated in 100K. So these are 100,000 pound corporate bonds. A typical corporate bond is such that if you want to buy that bond, you have to pay 100,000 pounds. Okay, and you own the bond. This bond will have a maturity date. Let's say 10 years. So there'll be a fixed date on which it matures. And the maturity date means that on that date, the company pays back the 100,000 pounds. Your bond is redeemed. Okay. It also has an interest rate, or what we call the coupon rate. Whatever that interest rate may be. Why we call it a coupon rate is in the old days, when you got a bond, you also got these small tickets attached to the bond. So every time you want to claim your interest, you tear off one part of the ticket, take it to the bank, and it will pay you your interest for that month, right? Or for that year. Right? Those are called coupons. So it was called coupon rate. So it's like a typical loan. The only difference is that it is designed as a financial instrument which you can buy and sell on the exchange. Now the other advantage is that, let's say you own this 100K bond. Okay, you own this 100K bond, and you want to, and you're getting an annual interest, and let's say you've had it for a year, and for some reason or the other, you want to get rid of it. You want to sell it. Can you? Well, normally you can. Provided you have a second-hand market for these bonds, you can sell these bonds on the open market. There is a secondary market for corporate bonds. You will find people willing to buy it off you. Maybe not at the same price you bought it, because why? The interest that is accrued to you is less than the interest that would normally be accrued. But there is a secondary market. You can actually sell it. Now, those of you who have done or will be doing corporate financial management will come across bond pricing. Yeah. And you'll be covering the pricing aspects of it in more detail. Now, it's not just the companies, the corporations that can issue a corporate bond, that can issue bonds. Governments do it all the time. Governments issue bonds as well, because the government at any point in time would need to borrow funds from the public to finance things like building roads, defense, etc. When a government issues bonds, we either call it a government bond or we simply call it a treasury. So when you hear the word treasuries, that is more or less alluding to, referring to those bonds that are issued by the government.
Yeah, so we can have the security, government security.
Yeah, it's a government bond. Yeah. Now, government bonds are considered to be safer than any other kind of bond because governments very rarely default. Thing with company bonds is if the company goes bankrupt, goes into insolvency, what happens to that bond? It may turn out to be worthless, right? With treasuries, which are issued by the government, it is very rarely that a government goes down under and are not able to pay back its public debt. But it did happen recently, and the country I'm thinking of is Greece. Greece could not pay back its debt, right? And the UK very recently was downgraded. Yeah, just like they have a credit rating for individuals. So if you're an individual, you would probably have a credit rating. How many of you know your credit rating? You would know your credit rating. And if you were to go for a ask for a loan, what they do is they do a credit check, and they'll probably get a credit rating on you. In the same way, individual countries have credit ratings. Individual companies have credit ratings as well. There are three companies that issue credit ratings. One is called Moody's, Standard and Poor's, and another company called Fitch. Okay, these are the three companies that actually analyze the credit rating of individual companies, individual corporations, in fact, individual debt instruments that are traded on the exchange, or major debt instruments that are traded on the exchange. And recently, the highest rating and different credit rating agencies, and these are called credit rating agencies. Different credit rating agencies have different systems, but all of them basically have AAA, which is the highest level of credit rating. That means these are very safe. These are the safest financial instruments you can find. And then it sort of comes back down, and then the lowest level is what they call a junk bond, which as the name suggests, is junk, right? So if you look on Wikipedia under credit rating agencies, you'll find different credit rating agencies, and you'll find the different systems that they use to classify the credit ratings. So if you are buying treasuries, if you are investing in what we call fixed income, you need to understand, you need to familiarize yourself with what is the credit rating of this instrument. How safe is this instrument going in? Okay. Now on your trading system, you do have treasuries. So for example, this is the 2-year note. This is an example of a treasury. 5-year note, 5-year treasury note, and 10-year treasury note, and the T-bond. These are examples of treasuries that you can trade. Okay, so if we look at the 10-year note, this is how the price has been moving on the 10-year note. Let's just have a look. Okay, so the 10-year note, this is the US 10-year note. The price has actually been falling, right? Possibly a good reason why it has been falling, and that's going to be part of your homework today. But you can see how these have been moving. In fact, treasury bills have all been falling. I think the 2-year note somewhat trending. Yeah, the 5-year note has also been falling recently. Okay. Now, the other portion of capital markets is the equity market, and we all know what an equity market is. It's a market for company shares. There are two kinds of company shares. There's one called the preference shares, and there's one called the ordinary shares. So when we refer to equity markets, we're looking at ordinary shares, because preference shares are not exactly what we call equity. They're a bit like debt instruments. So preference is spelled. Preference shares are not exactly equity. They're more like debt instruments, because every year, if you hold a preference share, the company has to pay you a certain amount of money. It's like a debt, right? So they're not really regarded as equity instruments, and they're not really traded. What are traded are the ordinary shares, what we call the common stock. So ordinary shares or common stock. Now, different companies have different shares. You can have HSBC, Apple, Google. They all have their shares listed on the exchange. What the exchanges have done, what has been done, is you have, if you take, you may have heard of something called the FTSE 100. Have you heard of the FTSE 100? Yeah. The FTSE 100 is the collection of the 100 largest shares floated on the London Stock Exchange. Yeah. The 100 largest shares, that means the companies with the largest amount of shares floated on the London Stock Exchange. The first 100, the top 100 of those. So they've taken these companies and they've looked at their price at any moment in time. What is the price of each of these companies? Or what is the price of company 1? What's the price of company 2? And so on and so forth, right? So till company 100. And they have averaged it. Now, it is not simply dividing it by the number of companies. There's a weighting system, which we'll get into a bit later on in the course. But they've averaged it. And using that average, they've come up with an index called the FTSE 100. Now, on your Oanda system, the FTSE 100 is denoted as UK 100. So that is the FTSE 100. Is the UK 100. And that is the average price of the 100 largest shares floated on the stock exchange, London Stock Exchange. Okay, and you can see how it's been moving for the last week. Can we get the last year? Leave it at the week, right? So yeah, this is actually the year. Yeah, this is weekly. Yeah, this is actually the year. Yeah. Now, in the same way, there are other stock market indices. This is the Swiss 20. This is the Europe 50, German 30, France 40, Japan 225, US Nasdaq 100, New Zealand 25, US Standard & Poor's 500, and Wall Street 30, and the Russian 2000, right? All these indices mean something. They are a collection of a sample of the stock market, so stocks listed on those stock exchanges, and the average price. So by looking at the UK 100, you can see how the stock market in the UK, the London Stock Exchange shares, have been moving on average. And you're actually able to trade these using your online system. Okay. Now. Now, the importance of capital markets to the real economy, and that's what I want to sort of take you through right now. Let me give you an example. Let's say we're talking about a company called a company such as British Airways. Okay. And let's say British Airways has noticed that there is a high demand, or expect a high demand for air travel. And to meet this high demand for air travel, they want to expand their fleet. Which means they want to buy more airplanes, buy more jets, buy more passenger jets. Does anyone know what a passenger jet would cost these days? 300 million. I think it goes into the billions. Yeah, it goes into the billions. No way Boeing is going to part with a
engine cost, I think 3 billion.
Engine alone costs 3 billion. I think it goes into the billions, right? We'll set you back something like 20 billion for a jumbo jet. Yeah, we can find out very quickly. Let's find out what the cost of a jumbo jet is. All of these airlines. Now, to do so, the company would have to raise some money, right? It may have some amount of funds in reserve. It may have been reserving it through the profits, but it would still need to raise some money in order to buy several of these jets. So let's say each one would cost, how many dollars did we say it was? 300 million. Okay, 300 million each. And let's say we want to buy 20 new jets. It's expanding, right? So that's a lot of money to you and me. Okay. So to raise this extra capital, the British Airways decides to issue more shares. Okay. So by issuing more shares, it would what you do when you issue more shares is you actually sell the shares, and in exchange for the shares, you get the money. Do you understand that? How the share system works? Yeah. Now, it has to issue these shares in the through the capital markets. However, in order to do that, it has to go through, let's say its bank is UBS. So UBS here is an example of a financial intermediary. Good. This is the financial intermediary. So the UBS will undertake the task of issuing shares on behalf of British Airways in the capital markets. Okay. Now, so the shares are there. Anyone can come and buy it, but who's going to buy it? Where's the money to buy it coming from? From savings, from people's savings. So let's say typical you. You're a working age person who is saving for old age. How many of you actually belong to pension funds, pension schemes? Okay, one of you. So you also belong to a pension scheme. You're really planning ahead, aren't you? Okay. Yeah. So let's say you got people who are working and who are working age, and part of their salary is going into their pension. Okay. And that pension, and you're actually investing in a pension, and that pension is managed by, say, company Aviva. All right. So now, how does Aviva, as a pension company, how do they manage your funds? I mean, they can't just keep it under their pillow, can they? They're gonna make your money make money, because they're gonna cover their costs as well, and they're gonna make a profit out of that as well. So what they do is they invest your money. Yeah, because you're not gonna need your cash until later on in life. So within that time, they should have invested your money wisely, and they should have made a return for themselves and you, right? So they engage in the capital market as well. So they're engaging in the capital markets looking for investment opportunities. So here you have UBS trying to sell shares, and here you have Aviva, who, using your money, is looking for an investment opportunity. You see how the two of them come together in the capital markets, right? And if Aviva sees this investment as a prospective investment, they will buy shares in British Airways, right? Now, this is the financial side of it. This whole thing is the financial side of it, right? But underlying the financial side, behind the financial transaction, there are some real people. There are some real entities. Here you have you relying on this investment for your future pension income. And here you have British Airways relying on this investment to buy more jets. And if you buy more jets, it will serve more customers. It'll employ more people, more pilots, more what do you call those people? People who serve your drinks and stuff. More flight attendants, more checkout clerks, cabin crew, yeah. So, and that creates more jobs, right? But without without the middle portion here, would this be possible? No, not really. It'll be far more protracted and far limited. Okay, and that takes us back to this diagram. How the financial markets bring the people who borrow, people who have extra funds, with the people who need extra funds. Okay, together. Okay, I'm going to skip that and come back to it in a future lesson, because that's a bit theoretical. Now, before we sort of take a short break, just want to finish off this aspect of it. The two things that I'm very keenly interested in are bonds and equities. There's fixed income and company shares. Now, your job is predominantly to trade these financial instruments in the open market, right? And you got to keep in mind that the prices of these instruments keep going up and down. As you saw in the graphs, the prices just keep going up and down. Question is, what is driving these prices? Exactly. The direct determinants of a price movement is based on the relative supply and the relative demand. If you have a situation where the demand for, say, a 10-year treasury bond goes up while the supply remains the same, there's no significant change in supply, you will have a situation where the price of that asset also goes up. Whereas if the supply of it goes up, which is people wanting to sell it, but there are not enough people wanting to buy it, the only way the people who want to sell it can sell all that they want to sell is if they accept to sell it at a lower price, right? And it's the same for any market. If there are more people wanting to buy it than there are people wanting to sell it, the only way the people wanting to sell it, people who have it, will be encouraged to part with it, to sell it, is if the price is high enough. So that sort of takes the prices higher. Whereas if it's the other way around, where there are not enough people wanting to buy it, they will have to lower the price in order to encourage them to buy it. So the price movements up and down are based on the supply and demand differentials. Okay? And a large part of understanding where the market is moving, why the market is doing it, is understanding what's affecting the demand and supply of a financial asset. Now, we'll take a short break and we'll go on to the remaining part after that.